Good evening to everyone. So, am I audible enough, guys?
Yeah, dear. Can continue. Yeah.
Okay, so thank you, sir. So, once again, good evening to everyone. So, under advanced business reporting, we have covered various aspects of the subject. So, be it SLFRSs, LKSs, or else accounting for complex groups, likewise. So, today as well, we are going to talk about a very important standard, which is SLFRS 9, financial instruments. So, to conduct the session for today, we have an ideal person who I would say is an expert in the field. So please allow me to introduce Ms. Binukshi Mohammadi, a seasoned professional in accounting advisory services at KPMG in Sri Lanka. She holds an associate membership with the Institute of Chartered Accountants of Sri Lanka and boasts a first-class BSc Special in Accounting from the University of Sri Jayawardhanapura. With extensive experience spanning multiple sectors, including banking, NBFIs, and more, Ms. Binukshi has spearheaded over 25 engagements across Sri Lanka, Maldives, and Saudi Arabia. Notably, she played a pivotal role in leading the debt restructuring program in Sri Lanka in collaboration with the central bank and the IMF. She also led model validation processes for numerous banks, performed valuation for treasury instruments, provided hedge accounting advisory services, and even developed an automated model for inflation rate prediction under hyperinflation conditions. Additionally, she conducted post-moratorium impact assessments for banks and NBFI and leads IFSRS 9 application and IFSRS 17 implementation gap analysis in Sri Lanka. Ms. Binukshi, we warmly welcome you for today's session and we extend our sincere gratitude for taking your valuable time for us today. So, without taking much of your time, let me hand over the session to Ms. Binukshi. Also, I would request my dear colleagues to give your fullest cooperation and support. So, Ms. Binukshi, over to you.
Binukshi, we can't hear you.
For the great introduction that you have given for the University of California for inviting me to conduct this session. Just let me join again.
No, now it's fine. Now it's fine. We can hear you now.
Okay. 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 So good evening, everyone, and thank you so much for the great introduction. Hope you all can hear me now.
Yeah, can hear now.
Yes. No. Okay. And thank you so much for giving this great opportunity to me and having this session with the students that I'm also kind of like just wanted to have a part of you all. So let me share my screen first before starting the session. And is it all good to start the session, Himal? Am I able to start it just around the time?
Yeah, go ahead. Yeah.
Okay. Okay, I'll share my screen. Just let me know when the screen is visible to you all. Hope screen is visible to everyone.
Yes, ma'am.
Yes, okay. So before kind of like starting the session at a very greater level of discussion, I would like to tell something or some sort of a thing about the banking and finance industry and the application of SLFRS 9. So the SLFRS 9 is basically the financial instrument applications are there when it comes to the what is the application in the banking industry and the finance company. And you might be thinking that SLFRS 9 is only applying in banking and finance industry, but majorly, yes, I would rather say, but some sort of industry is also there that also can consider SLFRS 9 in their application as well. Some manufacturing companies, some services company, as well as the insurance companies also can be applied SLFRS 9 based on the requirements and based on the conditions that we met. So basically, when it comes to the application of financial instrument, it is not a kind of like one standard as per the accounting standard regime. So it has kind of like a book of standards that we can rather say. So one is LKS 32 and one is SLFRS 7 and the next one is the SLFRS 9, I would say. So those three standards are kind of like a combination of applying the financial instrument rather than SLFRS 9 is slowly playing the role behind this application. So these are the key topics that I have selected for the discussion. Absolutely, those are not the exact or kind of like, hello, yes.
Actually, I think your slides are not, it's not moving, I think.
Is it not visible to you, Himan? Is it?
No, it's visible, but it's not moving.
Okay.
I think if you can put it as a slide show view, then
I'm putting it. Let me share the window again. Just let me know once you are can visible to the slideshow again. Is it visible, Himal, right now?
no, we can see your desktop, but we can't see the slides.
Okay. Is it visible to you now?
Now
I'm
it's okay.
just
Now it's
trying.
okay. Yeah.
Is it moving also, right?
Yeah, now it's moving. So can you put it
It's moving.
as a slideshow view
Okay,
then?
I'll put this. Yes, I'll put the slideshow. I put it. So, so what I just roughly go through the things that I have explained over the discussion at the beginning. So, when it comes to the application of financial instruments, it is not limited to the application of banking and finance industry. It is more or less rather kind of like applying for different type of industries such as manufacturing, services, as well as insurance. Plus, SLFRS 9 is not the only standard applying for the financial instrument part. We can use the LKS 32 and SLFRS 7 and SLFRS 9 as well. When it comes to the LKS 32, it mainly determine the definitions and the scope of activities and more is kind of like the terms and references to the financial instruments. And the SLFRS 7 is playing a kind of like presentation and disclosing standard. When it comes to the SLFRS 9, of course, it is playing a major role in the book of these standards. And SLFRS 9 gives you the measurement criteria, the recognitions, and everything that they are in the financial instruments other than those presentations and definitions things. So let's moving on with the topics that we are planned for the day. This is the content of the day for me. So I have picked kind of like 7 topics, which was not easy for me because SLFRS 9 and the application of financial instrument is a kind of like quite wider range of arrangements when it comes to the discussion purpose as well. But I try my best to pick the key topics that you all wanted to have a kind of like basic understanding or the foundation of understanding when it comes by one. So let's go with the beginning. So this is what I have explained you at the beginning also, how the case 32 playing a role here, how the SLFRS 7 playing a role here, how the SLFRS 9 playing a role here. Of course, SLFRS 9 contains more weightage than the SLKs 32 and SLFRS 7. I'll directly go to the scope that's there in the financial instrument standard under the SLFRS 9. So SLFRS 9 includes a lot of conditions under the financial instruments other than these. I would rather say in a very few words and within a one sentence. So the scope and the inclusions and exclusions can be stated as like that. It applies each and every financial instrument that's there under the definition other than these things. So when it comes to the subsidiaries and associate and the joint venture transactions, it's not applied as LFRS 9. And when it comes to the employee benefits plan also, it's not coming under LFRS 9. And share-based payment also not coming under this standard, as well as the insurance contracts under the SLFRS 4. I would remind here, now this SLFRS 4 is going to be going out with the IFRS 17, and the SLFRS 17 is going to replace this standard. And the lease rights when it comes to the SLFRS 16 and the revenue contracts that's coming under SLFRS 15, those are out of the scope. Why? Because these separately have their own standard separate in their books. No need of kind of like combining those items with the SLFRS 9 unless otherwise it's required and the conditions and the definition criteria are really met with the terms of the SLFRS 9. Yes, so when it comes to the financial instrument, it would be definitely a financial asset or a financial liability or equity separately. And you might be saying why this is kind of like very simple when it comes to the financial asset. Okay, financial liability, okay, equity, okay, those are coming under the financial instruments. Yes, financial instrument definition is quite easy, but defining the financial assets and arranging the financial liability and arranging the equity instrument is not that much easy for us when it comes to the requirement of the standards. Okay, so let's go one by one. I'm not going to take much time when it comes to those definitions because more interesting and more practical application of the standards are still coming up with the few slides that we are going to moving on. So when it comes to the definition part, it's very theoretical. Okay, you can kind of like memorize those facts and conditions in your memory, or you can write it up in your book, and you can easily get those points when it comes to the definitions. But behind these definitions, there are some hidden and implications that is not there indirectly that we have to apply in practically is the most crucial and most difficult part when it comes to those application part of the standards. So the financial asset, it must be a definitely a kind of like in terms of the cash, or it might be a kind of like right to receive cash, or it might be have a kind of like you have a kind of a investment in equity in a kind of like another entity, or you have a contractual right to receive cash, or kind of like a contractual right to exchange some sort of a financial asset and kind of like settling with the entity's own equity instruments. So I'll give you some few examples, then you all can get this point while applying these definitions as well. So if a person wants to kind of like invest in the stock market, so the person is going to open up a account and going to invest over there. Let's say you are going to buy some shares from Sampath Bank PLC or John TSP. Let's say you're going to buy that or you bought it. So when it comes to in your books, in perspectives of your books, those kind of like shares that you brought up is the financial asset because you have invested in someone's or another entity's equity. That derives the right of being a holding a financial asset. Let's say you wanted to kind of like have a contractual term with the customers that you are doing your service providing entity or product or whatever the things that you're selling. So customer wanted to have a credit term. Okay, there's customers say, I'm not going to pay it now. Let's say it's 1,000 rupees. I'm not going to pay it now. I'll pay it in next month. So you have a right to receive cash from your customer as a part of your revenue contract, and that receivable is a financial asset. So that kind of like small and simplified examples can be just give this more values to the definition. So this is the definition of the financial asset that the standard is saying. And when it comes to the financial liability, of course, the other part of the financial asset. So if you have a financial asset, definitely someone should hold financial liability in their books. That's the process. So that's the theoretical thing behind these procedures. So let's say you are going to receive same transaction. I'm referring the trade receivable or the 1,000 service that you are provided for the customer, but the customer agreed to pay it on next month. So from your point of view, you are having a right to receive cash, but the point of view from the customer is going to kind of like it is obligation to them to pay you. So the financial liability seems something similar to the this arrangement. That's kind of like the opposite side of the same coin. Someone has a contractual right to receive cash or financial asset or whatever the form. Someone on the around, they do also have contractual obligation to deliver cash or any other financial instrument. And it might be settled through your equity also. You might not be settling it. You are telling, no, I'm going to settle it through my own equity. I'm going to give you my shares on behalf of this arrangement. Okay, so the equity is very simple. Equity and the financial liability is kind of like crucial when it comes to the practical world, because segregation, like identification whether this instrument is an equity or financial liability, is quite challenging because both are holding very unique and very similar going characteristics in terms of their funds. So let me share the definition of financial liability. Definition as per the standard what is given there. So the equity asset and the liabilities after the portfolio, that is the residual interest part that you are holding. This topic separately in order to have a proper discussion, because financial asset is not that much separation. So this is really to have a discussion with you, because at the end, what's the purpose of learning these standards, or what is the purpose of having these applications in your book is to apply it practically. That is the most crucial and most important part that you all should have in your mind. Okay, so when it comes to the arrangement of those financial assets and financial liabilities and equities, you should be mindful when it comes to the contractual arrangement. That is the main part of how the cash flows are going on, how the services are going on here and there, how the payment terms are defining, how the interest rate is, those kind of like contractual arrangement in your instrument is the most crucial and most important part. So when it's come to the contractual arrangement, that is not necessary to be a written arrangement as per the law. As per the legality of the contractual arrangement, it doesn't require you to have a written agreement as a contractual agreement. It might be an implied one, it might be an oral one, it can be any form of way that is acceptable as a contract in front of legal or law bars. So that's what the standard also applied. So the contractual agreement not necessarily to be a written, or it is not required to be a paper that having in front of you. So the what is the most important thing is whichever the form that you are referring, whether it's written, oral, or implied, you should focus on the substance of the contractual arrangements. What is the payment method? What is the cash flow arrangement? What is the timeline? What is the payment of the cash flow? The occurrence of the payment of the cash flow? Those things you have to be focused when it comes to these definitions and the application of those instruments. Okay, so the first thing I took a kind of like small introduction for the financial liability thing. So if you have a kind of like direct, some transactions are directly says this is having an obligation. As an example, I take a kind of like as an example for a loan arrangement. I'm going to buy a loan from a bank or finance company or whatever. So if I'm going to buy a loan arrangement, that's quite straightforward. That's really fitting into this definition very straightforwardly. No need to kind of like define it in more way or kind of like go into your detail. It's very straightforward. Agreement say this is the loan that I'm taking, this is the interest I'm going to pay, and this is what happen if I'm not paid. So those arrangements are there. If you can directly decide, okay, this has a contractual obligation to deliver something when in terms of cash or any other financial asset, of course it's definitely coming under financial liability without having any argument. So the second point is, if it is not directly saying this is not a financial liability or not a equity or whatever the confusing thing that you are in mind, so you have to go to the next step and see. That also I will explain through and kind of like example rather than saying the same thing in this slide, because I think you all have already with this slide, so you can read it out later or at the same moment that I'm referring. But I would rather say some sort of things outside these boxes with some examples in terms of the practical words, and then you all can easy to get these points, because those points are having more technical jargons and more deep down meanings behind those words. Those kind of things are there. So this light blue color box is saying what happens if you are not directly said this instrument doesn't have a contractual obligation. So then you all can again go back and see about the deep down contract terms. So I will take an example in terms of the preference share issue. Okay, so let's say I'm going to issue some preference shares, and preference shares having a like unique characteristics. So if you directly heard the word, you can not decide just because of its shares. You can't say it's coming under equity. You have to see the terms. Okay, so I'm going to issue preference shares, and you are, let's say you are going to buy my preference shares while investing on me, and the terms are like that. Okay, the preference shares is this much, and the dividend payment is only after the allocation of all the liabilities and everything, and it is at the discretion of me. If I want only, I'm going to pay you as dividends, and no any other interest component over this arrangement as well. And these dividend shares are, it's perpetual, no realization date also. So if you go through the substance of these transactions, you can see, okay, no dividend is paying if I'm not willing to pay, and these shares are going to continue at the perpetual period, no kind of like no maturity period and no interest. For my feeling, it should be rather going with the shares or the equity component rather than in financial liability. So I'll take the same example in the other way around, how it comes to the financial liability side. Let's say the preference shares are there, and dividend is payable when it comes to when the profits are there, and the interest are there at 5%. Let's say it's 5% for the interest, and these preference shares will be matured on, let's say, after 5 years. It's more or less like I'm giving kind of like I'm taking a loan from my investors. You all are kind of like giving your money as a loan for me. I have to repay you back with interest, with capital repayment, and with dividends, such a kind of like profit margin. So it's more or less the financial liability. So if you focus on the same example having two phases with two characteristics or the two different types of contractual terms, So it gives you the two views and the two conclusions of having one is equity and one is financial liability. So this is the the detailed version of explanation behind these terms actually. Yes, I think I have already explained some sort of classification questions are there, and I think I have already taken some examples for me when I'm going through the slides as per the classification criteria as a basis introduction. So let's go one by one. So just wanted to note it down whether you have a idea about this classification thing. So I will kind of give you let's say it's 2 minutes. Just read out this. I might be picking someone and asking about the your classification based on this standard, as well as I might be explaining the answers for yours. Just take 2 minutes and read this moment, because I wanted to be this session more participative rather than I'm talking here and you all guys are listening. So just wanted to get your participation to the things in between, so those questions can be appeared in between those slides. Just go through this within taking 2 minutes. After 2 minutes, I think I'll be discussing what is the things behind this. Okay, I think the 2 minutes have passed. So let's go one by one. Just wanted to get the classification criteria, whether this is a financial liability or whether it's an equity or compound instrument, means it's whether contains the both of the conditions. It might be like there are some condition it has both phase of financial liability plus equity as well. So the first one is, I think, very easy when it comes to the explanation and the discussion purpose also. So the ordinary shares, it's nothing to discuss actually. The ordinary shares is that is your equity in the company when it comes to the ordinary shares, and the conditions of the ordinary shares are also very going with the conditions and the characteristics with equity, because ordinary shares is very irredeemable shares, and the dividend is paying only the discretion of the company, and it's kind of like very residual interest. It's settled down the investments of those ordinary shares only after recovering or the settling the liability or the financial liability or the rest of the liabilities, only after that you are getting the settlement to the ordinary shares that you have invested. So definitely it's coming under equity. Okay, so the redeemable preference shares with 5% fixed annual dividend, which is payable only if there are sufficient distributable profit available. Now the things are coming up. Redeemable shares mean you have a kind of like settlement period. Okay, so you have, it can be 5, it can be 10 years, it's redeemable, but the condition of the issuer also. And the 5% fixed annual dividend is there, but there is a small condition over that, that is only payable if the sufficient distributable profits are available. Distributable profit means the profits that they are available to the shareholders. Okay. So more or else kind of like having a equity in your books. Okay, so the every condition is lies with the issuer rather than having the conditions and the terms or the rights of the holder. It's everything is coming with the issuer. When it comes to those kind of like issuer oriented contracts, we more or less classify them as financial liability. No, it's coming under equity. When it comes to the oh, those kind of issuer oriented, issuer preferred contracts or the financial instruments are equity, because everything is determined by the issuer, not the holder. Holder doesn't have any idea of what's they are doing. So the preference redeemable, again is receivable, and the redeemable preference shares with discretionary dividends. And redeemable when you have a period, again I would rather say, and the discretionary dividends, that's also coming with the issuer. So the discretionary dividends are there, only the company are need to distribute your dividends. They are discrete. They are deciding whether you are getting the dividends or not. So that is also more or less coming under equity. So those kind of characteristics are there. So uh, the redeemable thing is the only, the doubtful thing here. If you see this, why the redeemable is not giving a kind of like financial liability phase, just because it has a redeemable phase, we can't say it's financial liability, because all the other conditions are lies with equity. So the fourth one, the convertible bond paying fixed interest, that's convertible into a fixed number of shares. So if you go to the definition directly, if you can see, so this bond is paying a fixed interest, and this convertible instrument is going to go to the shares. That means you have a bond, you are getting interest, but you are not getting the repaid or principal amount or the face value of this bond. Instead of that, what you are getting is a fixed number of shares. If you recall this slide, you can see it, what's happening there. If you have a fixed number of instruments that they are going to settle, so it's coming under equity. Okay, so I'll directly go with the reclassification criteria that's there in the equity to liability. What's happening if you try to transfer your equity to liability? Of course, those things has to be come up with your contractual terms. Okay, so reclassifications mean now you have equity, you are going to make it financial liability. Now you have financial liability, you are going to make it equity. So, how the things are going on here just depend on the changes of the contractual terms, purely based on that. Starting point should be there. Okay, why you need a reclassification? Because the contractual, the original terms are going to amend or changed. That is the base. So here the equity is going to change to the liability, how the accounting treatment is going on there. So if your equity is there in your books, you have to de-recognize it, because now the equity instrument is no longer in your books, no longer valid. You have to de-recognize it, and you have to recognize the financial liability separately at fair value, because recognition of financial instruments when it comes to the financial assets and the financial liability, at the initial point, it has to be at fair value. That's no argument on that. You have to get the fair value into your book. So even at the reclassification, you have to get the liability component as a fair value thing while recognizing your equity in your book. And the difference, okay, you might have equity for 1000 and you are going to recognize 1200 as your fair value of your new financial liability. But there is a difference between that. That 200 difference of arriving this fair value and the carrying value of equity, you should be adjust in your equity, not in your P&L. In your equity, you have to be adjust because you are de-recognizing equity, and the adjustment is should be reflect to the equity component. And the other way around here, the liability is reclassifying to the equity. So again, same thing. Okay, so you can initiate this reclassification process only if there is kind of like requirement to believe that the contractual terms or the conditions of this arrangement has been changed like that. So again, similar thing, you are de-recognizing your financial liability and you have to recognize your equity. Okay, equity, you have to recognize it based on the fair value of the reliable measurable in between those transition happening. And the only difference is that you're having is the difference between those recognized value in equity and the derecognized value in financial liability go to the P&L, because the changes of the financial liability is supposed to go to the P&L. And this is very basic point when it comes to the transition cost or the transaction cost, I would rather say. Kind of like when you're, let's say, when you want to invest in equity, you might incurring broker fees. When you want to invest in financial liability, you might get some commission charges. Those kind of like charges and expenses, or I would rather say the cost can be there. So the distribution of those costs and the transaction cost allocation is purely depending on the way that the instrument is going to treat. Okay, so the P&L and directly in equity based on the assessment of the cash flows plus the classification that you are making to the instrument. Okay, so the classification is the last part that we have just finished because of the transaction cost side. So the classification, when it comes to the classification, financial liability classifications are separately there, and the classification for the financial assets are separately there, and for the equity separately there. So I'll start with the financial assets. So if you can see the left side of these slides, it has three criteria under financial assets under SLFRS 9. So the one is amortized cost, other one is fair value through OCI or other comprehensive income. The other one is fair value through P&L or the profit or loss. So how we are deciding how my financial assets is going to classify under this or that? It's purely depending on your two things as per the standards. One is your business model. Business model in the sense, what is the purpose of having this instrument? What is the purpose of investing this instrument? What is your plan for the future with this instrument? That is the business model. And the second thing is the contractual cash flows. Is it reflecting the payments of the principal and the interest or not? what are the conditions under the contractual cash flows? Purely two things. If you can see the difference between each and everything, it's purely based on those two characteristics. I'll go one by one in detail so you can get a small idea about that. When it comes to the amortized cost, you have a plan of holding this asset for a long time. You are going to hold it. Okay, so that means let's take a kind of like example also. I'm going to invest on treasury bonds, government treasury bonds. So my plan is not going to sell it in a nearest future. I'm going to keep it until my maturity period is settling down. My maturity period is settling down until I'm going to keep it up. If it is 10 years treasury bond, I'm going to keep it under 10 years of period until it going to be matured. So the amortized cost model is applying for those kind of a business model. And my contractual terms should be purely reflect on the principal payment and the interest payment. When it comes to the treasury bond investment, so I'm getting a coupon payment as the interest, and I'm getting the realization of my face value at the end of the maturity period. That is the total idea or the classification criteria for the amortized costs. So the second thing is how we are going to classify the fair value through OCI. So when it comes to this OCI, you have both business models. One is you're going to keep this instrument until your maturity period, plus you have the expectation of trading as well. As an example, I'm not sure about as a management or the keyboard representative, I'm not sure about this instrument, whether I'm going to keep it until it's matured or I'm going to trade it. When the markets are in good terms, is it going to sell? I'm not just sure about that the recognition or reporting period. If you are not having what is the kind of like clear idea about what is your model of having this business model, so definitely you have to go with this fair value through OCI because you are not sure about this criteria. So when it comes to the fair value through PNL, it's kind of like residual thing. If you are not going to put it under amortized cost or fair value through OCI, definitely it should be coming under fair value through P&L. But it's definitely fair value through P&L is reflecting your trading purpose. You are buying instrument and selling it tomorrow just to gain your marketable benefit. That is your purpose. That is your trading purpose behind this arrangements. So the financial liability only contains kind of like two types of criterias or the classifications. One is fair value through P&L. The other one is amortized cost. So some financial liabilities are holding for the trading purpose. That's they are coming under fair value through P&L. So you are holding it just for the trading. Let's say I'm a factoring company. Yes, so I'm a factoring company, so I'm buying some payables or liabilities from the different companies. I'm selling it for a different party. So that is my business. So if it is my business of getting some financial liabilities for financial asset from the other one and giving it to another party, those kind of arrangements can be lead to the fair value through P&L characteristics. And the second point that you have to note it down is derivatives. Derivatives such as forward contracts, futures, interest rate swaps, currency swaps. Those kind of derivatives separately they are in the derivatives definition and coming under that definitely recognized under fair value through P&L if it is coming under financial liability. And the residual criteria for the financial liability arrangement also it's amortized cost here. So if you are not having a trading purpose or any other purpose like derivative holding or any other conditions, definitely you have to go with amortized cost. And most of the financial liabilities as per the market assessment or application example, I would say. So most of the things are coming under amortized cost here, because we can see very rarely in terms of having a trading components in financial liability. Derivatives are definitely coming under fair value 3 P&L, and it should be measured at fair value also at each reporting period. But other than these very few things, everything under the financial liability should be coming under amortized cost, and that is the most available category or the classification in the market as well. Okay. So you can see financial assets. I have been stated that debt instruments. So you all might be confusing this slide. Why? What's the difference? I'm like, once you're calling a financial asset, how it's becoming a debt? Because normally debt word is for the liabilities. So financial asset has two types of phases to them. One phase is debt phase, the other phase is equity phase. Okay, and that phase of instrument is purely depending on what you are investing. If you are investing in someone's debt, yes, for you it's a financial asset, but as well as it's a debt phased instrument. If you are investing someone's equity, yes, that's also financial assets for you, but that is not in debt phase, that is in equity phase. So those are the two phases in the financial assets that you can note it down, and two types of phases that determines different treatments here. So this flow chart give you a small kind of like background understanding what is going on under the financial asset, which I have been already explained. If this SPPI is the short term wording for the payment of principal and interest in company slowly, that means that you are containing the definitions and the control all the terms of the payments in terms of the principal and interest arrangement when it comes to those contractual cash flows. Same example, when it comes to the treasury bond or whatever the investment, treasury bill or whatever the investment that you're making, you're getting a coupon payment. That is your interest component. You might be take a kind of like part of realization to the face value, that is your payment of the principal. So based on this business model and your SPPI arrangement, it defines how the amortized cost is coming up, how the fair value through OCI is coming up, how the fair value 3 PNL is coming up. I'll go through these types of business models that we can noted in the market. So one is this you are going to help to collect these contractual terms, contractual cash flows. You're not going to realize it in between. You are going to hold it until its maturity. And selling asset is not a kind of a like objection or objective to this model, and it can be incidental. Okay, that means you can't say that, oh, you cannot sell this instrument for your life. You can't sell it. You can't say that. It can be incidental. No one is going to hold it until its maturity if the market is not going favor on us. Okay, if I'm not going to hold it until its maturity, if the market conditions are breaking down it, I'll definitely sell it. But it depends on those circumstances. My initial objective is to hold it, and my objective is clear for me as well as the investors as well. Definitely for everyone it's clear, but incidental situational circumstances can be occurred. That doesn't mean you can't take it up on amortized cost when it comes to the classification. And the second business model is you're having the both conditions. Okay, you have the contractual cash flows plus you have the selling purpose as well. And that also should be cleared. at the initial time as well as the each reporting period, you are not clear about what is your objective. Okay, you say, oh, I might be selling as well as I might be keeping it. That is your purpose. If it is that, so definitely you can keep it under your fair value through OCI category. So other business model means the residual one, definitely the fair value through P&L, the trading option. Other than these two, there will not be any other business model unless it's very specified to the situation. Okay, so another 2-minute example. Just read it out while taking 2 minutes and give me the answer after reading this, and just wanted to take their business model assessment. Okay, so let's go through the scenario first. So this it's a kind of like related to the trade receivable transaction. And Lila Tech has a business model that involves selling trade receivables, which is originates to the securitization of vehicle. So this you might be confusing this word, the securitization vehicle. What is this? Is it securitization vehicle? What is the vehicle here? Where is the vehicle here? No vehicle here. Normally, standard having a technical jargon for those kind of factoring entities or those kind of units as securitization vehicles. No vehicles like Toyota or BMW, Audi, like no vehicles over there, just a technical jargon over here. And the entity S, that's the kind of like originates the trade receivable part. So the Lila Tech de-recognize the trade receivables from their books, and after selling those trade receivables to the S, and S, that the entity, separate entity, is going to issue some sort of a trade receivable purchased through the notes in terms of the investors from their point of view. And the S, the collected entity of those receivables, they are collecting the contractual cash from the receivables, and they passes those collected cash flows to the investors. So that's how the arrangements are going on. And Lila Tech consolidates S. That means there is a kind of like those Lila Tech and S is in the same group. When it comes to the consolidation part, they are consolidating. That means they are in a same or similar group. So the question is how the recognition would be for the business model assessment. And I have derived the solution in terms of both ways, in terms of consolidations as well as the separate financial statements. So I'll tell you the separate financial thing first. So when it comes to the Lila Tech, it's a standalone entity. It's a separate entity in separate books. So now they have sold this trade receiver to the S. They are no going to liable or participating more any collection to the those trade receivables no more. Dialectic is now fully gone with these trade receivables. They don't care whether those customers are paid or not. They are nothing to bother. So they are very independent, very standalone. They have sold out their trade receivables. It's like this. You sold out your broken vehicle to someone else. Now the broken parts should be replaced by that person. You don't bother about it. You're not worrying about going to a repair center or whatever the place. You're just standing here and relaxing. That's what the Lila Tech also doing here. When it comes to the consolidations, now you can't have a kind of a like sleep or good relaxation here if you sold your broken vehicle to your wife. Why? Because if you two are under the same roof, your wife is again bothering you. Okay, what's happening here? Now you have sold me a broken vehicle, so we should go and repair it. We should do it. So now your family or the same similar transactions and the group things are coming here. Now, when it comes to the consolidation financials, Laila Tech and Entity S is one. It's a family now. Now, Entity S problems are also part of Laila Tech. So, when it comes to the consolidations, you have to keep these trade receivables while holding to collect these contractual cash flows. This is the logic behind this entity and the scenario that we have discussed. Okay, so again, small example. This is also relevant to the business model and assessment. Just take 2 minutes and read it, the conditions, read it out, because those things will be uh, kind of like cleared the doubts you had when I'm explaining the conditions and the terms in the standards. Just go through them. When I'm giving 2 minutes of time, just go through those technical terms and scenarios. This is capturing some real world examples. Okay, so I'll go through the conditions of the scenario. So the Lila Tech anticipates the capital expenditure in a future or few years time, and Lila Tech invests its excess cash in short term or the long term invest so that they can use them to fund their expenditures. Many of the investors have contractual maturities that is exceeding Lila Tech's anticipated investment period. That means, let's say, You want to just to invest those cash flow into kind of like 2 to 3 years. That is your plan. But none of the instruments or the investors are not going to accept this. They're saying no, we need to hold it until 5 years, 10 years. That's kind of like mismatch is there. Investments are held to collect the contractual cash flows, but when the opportunity arises, investments are sold to reinvest the cash flows in investment with a higher return. That means, so I'm planning to invest in order to hold it under maturity, but if the time permits, I'm going to reinvest in a different way while selling those. And the managers responsible for the portfolio are remunerated based on the overall return generated by the portfolio. So that's quite critical and that's quite triggering the situation here. Why? Managers responsible who is handling this portfolio is remunerated or the paid based on the overall return of the portfolio. It's not highlighting the return at the end or the between. Maybe the overall, that means reflecting the both. So if you're remunerated something with the return or the profit or whatever, definitely you are going to focus on that. If you are remunerated based on this, definitely you are going to focus on your return. You are not going to focus whether you are going to sell it or whether you are going to hold it. You are just only focusing you are going to hold it or sell it, whatever the conditions that you are getting a high return. So this reflects that you have both options in your plate. You have both meat, okay, whether it's pork or beef, you have both meat. At the initial point, you don't sure about I'm going to eat it pork or beef, but anyway, I'm sure I'm eating both. That is your plan. So if you have the both option like this, definitely it's coming under family through OCI as a arrangement classifications that we have discussed so far. Okay, so the business or model assessment thing, I'll go to the initial thing also. So I think I have told you there are two conditions to be determined further when it comes to the classifications. One thing is business model, and another thing is business principle and interest criteria. So what is this? Principle is the price of your instrument. It's purely the price that you are giving to this instrument. Okay, let's say your bond, you are going to invest a bond which is equaling 102 rupees in the market. So that is your principal, that is your purchase considerations that you have paid. You want to realize it. Okay, if you have invested 102 rupees of buying this trade receivable or the instrument, what you are referring is you just want to realize this 102 rupees definitely. You're going to realize it. So you're not going to like kept it. Maybe you are incurring losses or profit at the end, but your plan is to recover the principal and the interest component. Why we are charging interest to the instrument? What is the purpose of having them? So interest is like it's a major part of interest is representing the time value of money. So you definitely, when it comes to those financial instrument, you are going to keep it for a certain period. Maybe it's 1 month, 2 months, 12 months, 1 or 5 years, whatever the period. You are entertaining a time. You are enjoying a time. For the time, you are getting a value. That is the time value of money. That is the interest payment that you are getting as a major component. And there are some other margins like profit margins, those credit margins, credit risk margins, and the liquidity margins. Those can be there. But major part of the interest should be reflect your time value. Okay, so I'll give you some practical examples. Some instruments are very complicated when it comes to those classifications and how the SPPI is maintaining uh, role over here. Okay, so as an example, if you have a kind of like prepayment feature, like I'm getting a loan. Okay, I'm getting a loan, and at the initial point, my installments are determined, everything is determined, but I have a specific, very specific point of prepaying it. Like if it is a 5 years loan, the condition is there, I can pay it at the maturity or before maturity with a prepayment. After one years down the line, 2 years down the line, I'm going to prepay it. So those prepayment features are quite questioning whether you are really paying the principal or interest. Those kind of technical or complicated situations are there in terms of the practical world when you are determining this SPPI test. Okay, so if you noted this classification chart I had with the financial assets also. So this is the equity, very straightforward when it comes to the allocation, and very straightforward transaction is there. So the equity is having a policy choice, whether you are going to make it under OCI or fair value through P&L. Like even your equity instruments. Let's say running a company. I'm just buying some shares from another company and I'm selling them. That's my business. You are going to the stock market, you are buying some shares from the market, you are selling it. So it's held in for trade. So those kind of situations can be there. So if that is there, you can definitely go with the fair value through P&L. If you are not going with the holding or whatever the trading transactions, you have a OCI option if you are not having those trading purpose. But that OCI is option. Okay, so even though it's not coming under trading or whatever the thing that's called the under selling purposes, still you can have a policy choice of going with fair value through P&L, but that is irrecoverable. That means once you choose it, you can't coming back again to the other category. Once you choose it, it's the final decision. So this is the thing that I have been discussed with the policy choice under the fair value through PN. So when it comes to the reclassifications, reclassifications means in between those subcategories that we have talked about, like the amortized cost or the fair value through PNL, fair value through OCI. Those reclassification to the financial assets are permitted, but for the financial liabilities are not permitted. Why? Most of the reclassifications coming under financial liabilities are doing this just they wanted to have tax benefits with the changing of the models. Okay, so that's why normally they don't allow you to have reclassifications among the categories. So the next part of the session or the detailed discussion of financial instrument is the recognition and uh, de-recognition part. Actually, this is now like the more I'm going down with the slides, it's coming more practical topics to the discussion. Those definitions and those scope of things, those are very theoretical, very theoretical. Some practical kind of like applications can be complicate them, but very theoretical. You can memorize it, you can do it, but just because of you know them, you know the definition of financial asset, you know the definition of financial liability, that doesn't mean you can do it in practical world. So let's say, okay, now you have decided what is your financial asset and what is your classification, whether it's amortized cost or whether it's fair value through OCI or fair value through PNL. Now you have decided all those things down the ladder. Now the problem is, what is your initial recognition part? What is your recognize, and what or and when, and what is the amount, those kind of questions can be appeared. So when it comes to the financial instrument, definitely it has to be recognized in the statement of financial position. I would rather say the very old school name for this statement of financial position is balance sheet. So you have to recognize it once you identify it. On what? On what you are going to recognize this financial instruments? Initially, definitely at fair value. Initial recognition is definitely at fair value, despite of those categories, even the amortized cost, even the fair value 3P&L, and determining of this fair value is not a part of SLFRS 9. Then you have to go to the different standard, which is saying the fair value conditions of IFRS 13, and see whether you are determining the terms or the definition of the fair value. Of SLFRS 9, just say, okay, this is recognized at this and fair value and going on so on, and subsequent settlements and recognition so on. But no standard conditions are defining anything relating to the fair value because it's coming through a different set of standards. Okay, so the derecognition part. So the derecognition part is quite straightforward when it comes to the standards. You are no longer having the right or obligation to receive it or pay it, or you are going to transfer these things to the someone else, you are going to transfer these risk and rewards to the different party, you are going to sell it in a market. Those kind of straightforward recognition can be there that cancels the contractual cash flows. Then definitely you have to derecognize those things in your. So the one situation I have highlighted here is expiry of cash flows. That means, okay, now you have invested in a 5-year treasury bond. At the end of the 5 years of those maturity down the line, you have to definitely deal with receiving, and the paying process has been there. Now it's no longer you are receiving it or paying it. So it. And the other situation that can be occur is the transfer. The asset or the liability can be transferred. Okay, and this transferring thing, you have to be very careful whether you are transferring it on a kind of contractual way. If it's transferring on contractual way, definitely derecognized. But you wanted to have contractual obligation here, small component of obligation still I have. Those kind of situations are there. Yes, I have transferred, but receiving the cash flow, right, is still with me. If those kind of situations are there, your assets or the liabilities or whatever the thing cannot be derecognized because you are no longer transferring properly when it comes to the risk and rewards assessed with this instrument. When it comes to the financial liability, also same thing. Okay, so when it comes to the financial asset, that is derecognized when all the contractual rights are expired or cancelled. Same as in financial liability, you are going to derecognize it when all the obligation to receive those cash or the financial assets or the liability, whatever the thing assigned here, is going to expire or cancelled here. So the modifications of financial liabilities also can be there. Some sort of a big modifications are there, no? When you are invested or when you take a no kind of a granted loan, you are getting it. But in between, you are changing a lot of the conditions, interest rate terms, and the prepayments. Those kind of things are there. If it is a substantial modification, now the expiry of the cash flow has not happened. You have not transferred also. You have not sell it also. what happens is you are going to continue the same instrument, but the modification to the terms are happening. You have to determine whether those modifications are substantial or not. And standard doesn't specify how you determine the substantial here. It's judgmental. Okay? What is my threshold of substantial modification is purely depending on me. Okay, it's judgmental to me, as well as it's not challengeable from the other parties as well. So let's say my interest rate is just for a loan, it's 30%. Now it has become 29.5. I'm saying, okay, this 0.5 modification to the interest is very substantial for me. I'm going to de-recognize this and recognize it at a different or new instrument. So my external auditor come and say what's happened in this transaction. 0.5 interest only has been reduced. How would you say it's substantial? I would say, oh no, this is my judgmental. I have the right of taking my own judgmental, my professional judgment based on the standard. So I took it as a substantial. But as for the common sense or the general perception of those modifications, you can see it's not a substantial. That's not a significant modification. That's not a big thing to de-recognize your existing instrument and recognize it in different term. So that's a small modification that you made to the interest rate. That's not substantial at all. So those kind of things can be happen in the practical world. Okay, so now I'll again remind you the timeline or the planning that we have come. First, we have determined what is the definitions, what is the scope, and we determine, okay, this is financial assets, this is financial liability, this is equity we come across. Then we go with the, the recognition part and the de-recognition part and classification of those things we come to them. Now, after you do all the things, you have to have a number to record in your books. Okay, you have to have a good score in your subjects in order to have it in your transcript. Something like this. So this is the initial measurement that you can take care of for grant. I think I have already specified this. All the financial instruments coming under SLFRS 9 should be recognized at fair value. That is the initial measurement. And IFRS 13, similarly, SLFRS 13 can be determined, the way of determining it, way of getting the fair value. As an example, I'll call it a bit. It's a kind of like marketable circumstances, and participations should be there in terms of the third parties that they are in the market, and that's how the transaction is dealing their transaction price. Okay, let's say I'll get the same example. So you're selling your broken vehicle to the wife just for 1 million, but you can't sell this broken vehicle to a third party for 1 million, because just because of your being your wife, they can get the vehicle for 1 million, but no one is going to take a broken vehicle for 1 million unless it's your wife or girlfriend or whoever in your family. So that means that 1 million is not the fair value of that instrument at all, because it's not reflecting the marketable conditions of the third parties with the arm's length of transaction. It's not reflecting that as per the SLFRS 13 or the IFRS 13. So this is something that I have been said so far, how the fair value is determined in the market, and SLFRS 13 having a lot of conditions, level 1 inputs, level 2 inputs, level 3 inputs. Level 1 inputs means the directly evidenced data in the market, which is observables. Level 2 can be having the same data with small adjustments. Level 3 inputs can be very technical, determining of like present value of getting the cash flows or some sort of a things. So initial recognition is very simple and straightforward. You have to recognize it at fair value, but subsequent settlements or the subsequent measurements are depending on the category that you are holding. Okay, so when it comes to the amortized cost, what is going to the profit and loss? It's interest income, ECL. ECL means the expected credit loss. It's also coming under the impairment part of this session. It will be coming up with the slides, and those foreign exchange gain or losses can be going through. And for the amortized cost, there is no involvement for the OCI, but fair value through OCI, definitely the fair value changes are recorded in OCI. So when it comes to the equity instruments under fair value through OCI, the dividends can be there in P&L, and the fair value changes can be there in OCI, and that is never will be reclassified to the P&L, and the debt instruments at fair value through OCI can be classified to the P&L. And the fair value through P&L, OCI is not applicable at all. All the fair value changes, whatever the changes that they are in books, can be recorded in P&L. So this is the subsequent measurement to the financial liability, same as financial assets, nothing going to be changed. Everything is similar, but only the two phases are in the coins. Okay, so now you are having I said the financial assets reclassification is possible. It's permitted under this standard, and this is what you can recognize. I'll tell only one example out of this matrix, because it can be have 6 or it can be have different types of situations. But I'm taking only one example just to explain this transition thing, in order to get a kind of like small idea. Otherwise, it will become very boring, very annoying while saying each and every criteria with so much of technical topics. So I'll say this. I'm going to transfer my financial asset. Initially, I have recognized it as amortized cost. Now I'm going to change to the fair value through P&L. I'm referring this last box. Okay, left side, last box I'm referring. So when it comes to the amortized cost, what is my business model? My business model is to continue my contractual cash flows until its maturity. I'm suddenly changing my business model. No, I'm going to sell it in a nearest future. That's what I'm going to practice. So what's happening here is I have to recognize it for the fair value. So the amortized cost subsequent measurement is not fair value at all. It's amortized cost based on EIR method. So initially, definitely I'm going to record it at fair value, but in a subsequent period, I don't have any fair value here. Now I have to fair value this instrument and recognize it at the fair value through P&L as the fair value. And the difference between those two, definitely there might be a difference between the carrying amount and the fair value, and it should be goes to the P&L. Very simple. Like getting the fair value of those instruments when it comes to the assertion is the most important part here. Yes, this is the topic that I have highlighted here, the expected credit loss. Impairment model. Okay, so I'll tell you some sort of background data for this thing. The previous standards was there for the financial instrument is IS 39. Okay, so that doesn't had a proper impairment model at that time, and Slfrs 9 was replaced with the sound and robust impairment model, I would say. So when it comes to the SLFRS 9's impairment model, it's very forward looking, it's very futuristic, it's focusing the future rather than being in present conditions. So that's why the loss is telling it as expected credit loss. It's your expectation, whether it's incurred or not in actual world or actual books, you are going to recognize it as an expected loss. So the expected credit loss or the impairment is purely applying for the financial assets only. Nothing to impair if it is financial liability. You have to pay it. Okay, people might be really happy or enjoyed or thrilled or excited or whatever the term if they wanted to impair their financial liabilities also. Okay, so if I have a loan of 500 million, if I can impair it entirely, I would be rather dying, okay, not impairing it. But standard doesn't allow it. You only can impair financial assets because that is the risk having the party. The hold of the financial liability is not having the risk at all. I just have to oblige, I just have to pay it. But the financial assets, you are having the risk. What is the risk? The credit risk. Okay, you are very scared of getting it or not, or what is the amount I'm getting it. Like you might be shivering in your daytime or nighttime, whatever the time when you are remembering those investments. Let's say you have taken 500 million of loan from someone, okay, and the party who has given you the loan will be having a huge risk whether you are going to pay that or not. That is the credit risk. It's very common word. It's very, I would say, the general word in this environment, in this world, when it comes to this assessment. So, financial assets definitely coming under the scope, but there are few out of scopes also impairment. I will tell you the components while with having examples also. One thing is equity. Okay, so the equity investments, you don't need to impair because there is no any credit alignment over here. It doesn't having a debt nature. Credit means what? It should have a debt phase. And financial instrument measured at fair value through P&L, you don't need to assess the credit risk over here because you are fair valuing it at each reporting period, and you are recognizing the market changes, the market risk, the illiquidity premiums or the illiquidity risk that reflect part of the credit risk also in your P&L. Fair value through OCI is not recognizing those components in P&L. They are going to have it in OCI. That's why we are having a impairment for that. Okay. So now the word is coming. ACL. 12 months ACL is there. Lifetime ACL is there. So you might be wondering what is this words? What are the words I'm hearing for the first time, or might be you all are familiar with them, because I think some of the students are having some work experience here, so might be having those kind of experience with these impairment models while having internships or while having some sort of previous lectures. But this is very practical. Standard is very silent over these topics. They don't specify how to do it, how to compute it, how to specify it. Nothing is going to specify, but they are just saying this is the concept, this is the thing that you have to do at the end, but not at all explaining the process about it. So the 12 months ACL means I have like explain you this is a very forward looking approach. 12 months means you should not be focused about your historical reporting period. You should focus on your coming 12 months. If my financial year is 31st December 2023, I would focus on next 12 months and upcoming 12 months for my assessment. And lifetime means definitely you are standing on the today's or present point. You are focusing on the lifetime of the contract, lifetime of the contract period, and you are booking a expected credit loss to your books. Okay, and these 12 months or lifetime or whatever the ECL is depending on your credit risk assessment, how your credit risk has been increased or decreased or significantly increased or significantly decreased or credit impaired, whatever the credit risk assessment is the key part of determining those roles. So this is the like very summary of the ACL concepts. 12 months is, as I said, it's 12 months after your reporting date. Lifetime is your expected lifetime after the instrument. And significant increase in credit risk not defining SLFRS 9, default point not defining SLFRS 9, but there are practical conditions. I'll say a small example for this. Let's say I am taking a loan from a bank, and I'm not paying loan installments on due date for continuously for like 2 months. I haven't paid it. Now the bank knows, okay, this person is quite risky. Whether this person is paying my cash or the credit on time or not is very questionable now. That means from the bank point of view, their credit risk on me has significantly increased. And the default, I haven't paid my loan installments for 5 consecutive periods. Now I'm not paying. Almost half a year I haven't paid. Now the bank knows, okay, this person is not for paying more than even 90 days now. Now this person is not even in credit increase part, but in default. This person should be labeled as a default person. I might be bankrupt at that time. I might be go insane. I might be go to jail. Those kind of things can be happen. So that in that time, bank recognize me as someone who has defaulted their loan. So I just took both quantitative indicators plus qualitative indicators as well. So the quantitative indicators that we can use is the number of days in arrears, number of rental in arrears that we use, and those are the very basic of quantitative evidences we have for the significant increase or the default definition part. When it comes to the qualitative things, yeah, there might be like, if I'm a corporate customer, let's say I'm running a business and I got the loan for my business activities, but my audited financial statements are not giving proper conclusions, not having proper opinions. That's qualitative to the bank side. So those kind of indicators can be there determined through the determination of default point. And standard slightly says 90 days can be considered as a quantitative default point, but it is a rebuttable presumption. That means you can challenge it, you can exceed it as well. Standard doesn't say this is the thing that you have to use, you are about to take the judgment. Okay, so the low credit risk things are there, like you are paying it properly, you are paying it on time, and you have capacity, you have assets in your books, you have properties in your hand. So those kind of things are there. Those kind of customers are very low risk customers that they are paying on time. So only the concern is what here is only if it's easier if you focus like this. You just have to focus what is the point, what is the triggering event that is kind of like limiting your payment to the bank, limiting your repayment to the bank. What is the exact thing that is limiting or controlling you not to pay to the bank? Yes, so the even though the standard is saying like this, this ECL is present value of cash flows, and is there is difference between those gross amount. But uh, when it comes to this application is very hard. Okay, you cannot easily determine your cash outflows. You cannot easily determine your rates of ECL. So I'll tell you some sort of a practical working sheet also. I'll show you that after finishing this session. I'll show you separate Excel working of determining one parameter here under ECL. So that's how we are doing it on practical world. So the books are saying something, and when it comes to the applications, it's very complicated and very limited. And when it comes to the country like Sri Lanka, the data limitations are there, the history of getting those details from the bank, so the whatever the things are very rare. We have enlarged with the technology with the recent ways that that's why we have kind of like bankrupted as a nation at a certain time, and we have lost our governance side, and we have lost the, the kind of like trust towards to the bilateral debtors, I would say the international creditors in certain time. That's why I have defaulted. That's a kind of like a very big example also that you can take it up. So we as a country we have defaulted. That means we just failed to repay our foreign currency loans to the creditors on time. So that's what happened at that time. So if we are not paying even as a country, so they labeled it as a bankrupt country, as same as the banks are defining it, or label it as persons. So the ECL measurement is not something the standard is specifying at all, but I will say a small formula for that when I'm explaining one parameter through the Excel working after finishing this. So this kind of things are there. How you are discounting and how you are getting the cash shortfalls. Cash shortfalls means you are like, let's say your installment in 1 million per month. Okay. So you are expected to receive 1 million. That's your expectation. But something has happened. Okay. The client is, or the customer is not paying well, and giving some arrears, giving some due dates. Now, are you in a position to expect the cash flows as per the installment plan? My answer would say no. Why? You have some triggering points. You have some indications this client is not going paying well hereafter. So you are predicting no, this client can't be paid 1 million now. I expect only 200,000. 800,000 I'm going to lose. That is my cash shortfall. That is my cash flow down for the short and down as per the expectation that I had. And I have said this is a expected loss measurement. Okay, so this is not an incurred loss model. This is an expected loss model. So you have to determine your futuristic things, how the external economy is going on, how the macroeconomic is going on, how the microeconomic conditions are going on. So based on only you are determining your ECL, or the expected credit loss assessment. It is very forward looking. You have to predict your economic conditions as well. I'll tell you the practical example. So we faced a crisis after post-COVID effects. We went to the bankrupt line, and we had a lot of political instabilities and economic stabilities during few years time. And we faced almost kind of like hyperinflation amount. Like we almost went to the hyperinflation conditions. If the inflation grows more than 100%, it's the country is almost determining as hyperinflated country. We went to the that point, almost we went to the line, but gladly or luckily we came back, almost touching after 100%, we came back. That's what happened. So at that time, predicting the economic condition is very difficult for us as clients, as the technical teams. It's very hard. Standard doesn't say those things. Those practical things, standard doesn't say. Even we face for the first time, we model it for the first time, we determine it for the first time, and now we know how to tackle the crisis. But we never know what's happening in the economy. We are quite better than those few months, but not fully recovered. We are still in the recovery process of in terms of very beginner level, but we never know what's happening. The election is coming up. We never know how the economic conditions, how the GDP rates, how the inflation rates are going on during the political period. After political events, what's happening? We never know. And we haven't still yet started to repay the IMF installments. We are still uh, keeping the reserves as it is. That's why the dollar rates are going down a bit. But if we have started repaying it for the IMF or whatever the bilateral debtors installments, definitely again the dollar rates will go up. If the dollar's rates are going up in a country like us, which is purely based on imports rather than home manufacturers, definitely our economy will be damaged again. So we'll have a tough time again if that's happened, unless we have a proper plan for the installment repayment. They are just deferring the installment. We have to anyway pay them. Otherwise, they will take our assets as loans. But so some kind of like getting countries' assets is not a like easy way of getting a mortgage like us. So definitely we have to pay them. So those kind of things we cannot predict. We are not in positive or negative pay. We don't know what will be go. Maybe in positive terms we might be grow. Okay, so the even in December 2023 in last year, even IMF predicted a positive 1.8 of GDP for the upcoming year for Sri Lanka. They said even IMF is thinking that we are in a positive way to go, because in 2023 we had a negative GDP. In 2022 we had, like past few years we had 2 to 3 negative GDPs. Even IMF thinks no, we will grow in positive way also we can think. But the problem is, how would you know until it happens? Do you kind of like, are you in a position to able to predict all them? That is the problem when it comes to the practical application of those conditions. So like as I said, the lifetime of the contract should be considered as the period for the exposure. So the when we are predicting the lifetime expected credit loss, we have to consider the maximum period of time the contract is going to be extend or obliged. Okay, so ECL is having a small, like few approaches: general approach, simplified approach, specified approach. And general approach is more or less with the financial instrument which is having a interest component. That means loan with a interest component, treasury bond with the interest component. Okay, so the simplified approach is there for the financial instrument that doesn't have a financial significant financial component, such as trade receivables, contract assets, those kind of things. The specified approach is for the credit impaired assets. That's purely for the credit impaired asset. So the interest recognition, like those instruments, interest recognition also different when it comes to those stages that you are categorized under this ECL. So the this no significant increase in credit risk and the significant increase in credit risk. So those three dark blue boxes. First one is stage one. The second one is stage two. This credit impaired one is stage three. For this stage one and two, definitely you are going to recognize your interest at gross. But for the credit impaired, you're not going to get the interest at gross, but instead of net amount of, like after deducting all the ECL, that you're going to recognize the interest. That's the practical thing. Okay, so I think we have moved for the final part of the discussion, and that is also hedge accounting, very complicated area, even more complicated than ECL, very complicated in terms of application. But I will take you through the basics and few things that you want to know when it comes to these things as a part of or outgoing having of this discussion. So the hedge accounting is what? So you are facing different types of risk in the business, okay? Different types of interest rate, price risk, those kind of like risks can be avoided, mitigated through different terms. Like let's say you are getting a floating rate loan, you are getting a floating rate loan here, and you don't know about your interest rates. It's very unpredictable. It can be go up, it can be go down. You don't know about it. What you are going to do is you are going to get another instrument against this floating rate debt as interest rate swap agreement. You are going to the another bank or the same bank can be. You go and say, here, look here, I have a floating debt instrument. I can't take this interest rate anymore. My heart is racing. I'm going to have a heart attack when the interest rates are published. So, can you give me a solution? You're going to say it. The bank will say, look here, there is an option for that. There is an instrument for that. Separately, you can have it. What I'm going to do is, you and me, let's enter into the arrangement called interest rate swap. I'll pay you the variable interest rate. You pay me the fixed interest rate. So that's their separate arrangement. Now the company is out of the danger because the variable rate I should pay to the bank B, I'm getting it from the interest rate swap agreement and I can pass it to the bank. Instead of that, what I'm saying is I'm only paying the fixed to the interest rate swap. So those kind of instruments, derivatives are available, and those are the key discussions behind this hedge accounting. The hedge accounting means you have a interest rate swaps, that's a derivative, separately in your books, and floating rate loan separately in your books. Now your risk is no more there. Your risk is going to getting more down. Now no need of passing those fair value entries to the P&L. Don't make it your P&L more volatile, while do it separately, while you're like you have two items in your financial positions, but if you are going to record it separately, your P&L is going up, going down, your P&L is going to affect it through the fair valuation of those instruments. Those are through the forex gain knowledge of those instruments. So the standard says, say, go and apply hedge accounting. Now connect them together and settle their cash flows together. Only the net impact is going to be recorded. Now the impact for the P&L is very low. That's the key purpose or the main discussion behind this hedge accounting. And I'll take the same example, the floating debt instrument. So the floating debt instrument is a recognized liability in my book. It's a recognized liability in my book. That's being recognized in my books. I can make it as a hedge item under the qualifying hedge item definitions, as you all can see in this slide. Okay, and the other hand, I have the interest rate swap. So the interest rate swap is qualifying as a recognized asset or the commitment as the hedge instrument. Now I have the item, now I have the hedge instrument, now I can do the hedge accounting. So standard determine what is the definition of hedge items and the hedge instruments, and definition of hedge accounting and how to do it. So hedge accounting also have few models, fair value hedges, cash flow hedges, net investment hedges. I'll briefly explain this each and everything because going to the deep down of those two hedge instruments and going to the entries is very complicated in practical world. So getting the basics will be helpful you to understand these models at this moment. And the fair value hedges means your risk is at fair value. You are worrying about your fair value. What's happening to my fair value? Okay, I'm going to hedge my fair value. Cash flow hedges means you are worrying about your cash flows. Okay, I'm worrying about my interest payments. I'm worrying about my interest income. That's my cash flow. That is the cash flow hedges. So the net investment hedges means now sometimes the entities are investing in foreign subsidiary, foreign entities. So when it comes to those foreign subsidiary or the foreign investments, there is a hedge type called net investment hedge. In Sri Lanka, very rarely we can see it because rather than other countries acquiring our companies, it's very rare to see our companies are acquiring the other companies. So that's why Sri Lanka is not having those models in often. We do have, but not like in fair value hedges and cash flow hedges. Even those two are also very rare to see. Why we don't have a active derivative market in Sri Lanka. We don't have an active market for the forwards. We don't have active market for the futures. We don't have active market for the interest rate swaps. We just have very simplified vanilla type instruments. So hedge account is quite very uh, very not using component in terms of Sri Lankan context. So if it is fair value, definitely what's happening in your hedge instruments means that interest rate swaps should be measured at fair value, and those changes should be go to the P&L. And the hedge item, the measurement of the fair value, that the risk that you have kind of like hedged can be recognized in P&L. Those can be set off against. Okay, so that's what happening in your P&L, and the reserve can be set off all those fair value changes through the P&L. And the net investment is very quite easy. It's all the entries are going with the OCI other than the disposable entries. So yes, when it comes to the cash flow hedge arrangement, you have a OCI reserve, and that OCI reserve is passing to the P&L over the time that the cash flows are occurring to the derivatives and the loan or the hedge instruments that you have paid and the hedge item that you have considered. That's what happening to the cash flow hedges. And there's one more important thing under the hedge documentation and the hedge effectiveness assessment. Hedge documentation means if you want to have a hedge, you should create a documentation. Okay, it might be included with what is your risk, how you are going to mitigate it, and how you are going to assess your effectiveness, how you are going to measure your ineffectiveness. Ineffectiveness means your hedge transaction is no longer set off in your cash flows. It's arriving some sort of negative things to your books. Then you have to get that portion and record it separately to the P&L. So this economic assessment or the effectiveness assessment is, so the hedge instrument and the hedge item should have a good connection, good economic connection. Okay, so the both parties should be benefited as you expected. Okay, so the let's say your loan is also giving negative things, or and your interest rate also giving negative things. That doesn't mean any kind of that doesn't give you any meaning for this relationship, right? So if you have both negatives, how you are setting off? One should be at positive. So those kind of effectiveness assessment should be made and see whether it's okay to go or not. So that's kind of like total of the discussions that I have planned as the presentations, and I have highlighted you. Just wanted to check small thing relevant to ECL. Hope everyone see my screen. I'm sharing an Excel here. Himal, is it visible, the Excel sheet here?
Yeah, you can see, Yeah.
Yes, no? Okay. So I'll tell you the formula for this. ECL is mainly, it's about PD, this multiplication sign, LGD, it's EAD, it's discounting factor here. I'll tell you the terms as well. It's EFM. Okay, this ECL is expected credit loss, and the PD is probability of default, and the LGD is loss given at default, and the EAD is exposure at default, and the DFA is discounting factor, and EFA is economic factor adjustment. PD means like what is the probability of going default? How is it probable? LGD means one, it's default now. Your contract is default. How kind of like I'm going to recover it now? What is the portion of my recovery? EAD means your exposure. Entire exposure is at default at a certain time. Discounting factor, we can definitely take it as EIR of the rates. And the economic factor adjustment is the adjustment that we can use for the ECL assessment as a forward-looking thing. We are make it more forward-looking while predicting those economic conditions. So I got some random data here. If you all can see, month end, product type. This aging is the months of arrears. How many months? Oh, how many? Like it can be rental in arrears as well. Days past due also. Number of days that you have passed. Number of arrears rentals you have passed. So this is not much in much. It is something that you are bucketing this. Okay, you are bucketing this into a certain group. So I'll tell you the summary of this as well. Okay, so if you take it up, those conditions bucket, this one is current bucket. Okay, that means zero arrears. The second one is you have 1 to 30 days in arrears. Okay, you have 1 to 30 days in arrears. You have 31 to 60 days in arrears here. You have 61 to 90 days in arrears here. You have more than 90 days arrears here. So you might be thinking, those things specified in standard. No, these things will not be specified in standard. Standards will not say those things to your consideration. It will say something very general. These are the things that we have to do practical. So this line of this pivot table is the beginning condition of the contract. If the these are the end position of those contracts, these are the end position of those contracts. So I'll explain it very simplified way. You have 75 contracts in your CRO area. Okay, you have 75 contracts in your zero arrears. What happened to these 75 during bucket or the no arrears bucket? Contract has go to 30, 1 to 60, and 6 contracts have gone to 61 to 90, and 4 contracts has been past the default point as becoming more than 90 days arrears. Similar for these as well. 29 contracts was there at the beginning of the year for this bucket, 1 to 30 days in arrears. See what happening to these 29 contract during the 1 years down the line. 13 is still there in the same position. 8 is moved to 61 to 90, and 3 to move to the fourth bucket, and 5 contracts has been defaulted while becoming more than 90 days. So this is how your probability of default rates are calculating. Like this, 4 contracts out of this 75 has been defaulted in the first bucket, or the current, or the no arrears bucket. 5 out of 29 has been defaulted or past the default point out of 1 to 30 days arrears bucket. So those kind of arrangements can be continued. Okay, those kind of arrangement can be continued for the determination of those practical terms in the ECL. So this is one parameter. I'm not going to detail discussion of having each and every parameter. I'm just wanted to elaborate you over the things that we are doing practically as well, because explaining the terms and the conditions that they are in the slides will not be giving you the realistic picture out of the applications. I just wanted to give something that we do normally, and we do as a firm, and we do as a consultancy firm, and this is in the finance company across the industry. This is the way of determining themselves, and not only Sri Lanka. I have seen the computations from other countries as well. This is the way of doing that. So practical application is quite challenging, but it's not I'm not saying it's users and having good understanding over the theoretical background. It will be definitely make it easier to understand well as practice. So this will be kind of like ending my discussion with this assessment of the banking sector. If there is any question, I'm very welcome to answer. So hopefully you all have questions, because normally if I do address the Sri Lankan crowd, they don't have the questions. But I'm expecting some sort of at least few questions from your end, just to be interactive with you, because whole the time I was talking here and you all guys listening here. I'm not sure whether you all are there or got the points that I'm saying. So if you can say or raise questions that you're not clear with up, you can take the time and raise it. I'll be happy to, and more than enough happy to have a contractual and the conversation with you all, just to deliver some sort of ideas I have. And thank you so much for giving me the opportunity for the University of Calgary and address them. This valuable moment is really appreciated. Thank you so much for having me. Over to you, Hima.
Thank you, madam. So yeah, thank you so much. First of all, I would like to really thank you on behalf of the Department of Accountancy for your valuable contribution for us today with this session. I mean, you gave us beyond what it is with your practical examples and with your experiences, and giving us small examples so that we can understand the thing which you are telling to us. So thank you so much for this fruitful session. I mean, we all like I mean, you said it was your opportunity, but truly it's our opportunity to have been in this session with you, since you're an expert in the field. So yeah, thank you so much on behalf of the Department of Accountancy. So yeah, and to my fellow colleagues, I'll be sharing the feedback form for you guys. Please do fill the form and yeah, and submit it. Yeah, once again, ma'am, just thank you so much for being with us today in this session, and having doing the great session. And thank you so much for your time. And yeah, thank you so much, ma'am.
Thank you so much. You're welcome.
Meenakshi, I want to thank you for accepting my invitation, because we were actually in the same group when we were in KPMG. So as I'm asking you to do the IFRS 9 for our students, so you have accepted without any hesitation. So thank you very much for that. So let's meet on next session, hopefully physically, right? So thank you very much for accepting our invitation. Thank you.
Yes, Hima. Thank you so much for having me and reminding those memories. Thank you so much.
Yeah, with that, we can call it a day. And once again, ma'am, thank you so much. And thank you guys for your participation. Please do fill out the feedback form, which I dropped in the chat. So, yeah, thank you so much.
And also, students, I will share the attendance QR code so you can mark your attendance.